Good afternoon, everybody, and welcome to the How to Build a Chain track. We have an action-packed panelist today, and we're covering things on what it takes to design, scale a blockchain. First and foremost, I think we have one of the more important panels today, where we're talking about how to craft incentive programs that actually work. So let's give it up for the panelists.
Hey everyone. It's nice to chat. We're just going to be talking about incentive programs. I think this is the most important conversation at the whole conference, but I'm biased. And I have some great people up here that we're going to talk about incentive programs with. The objective here is to solve a couple problems and answer and provide some value to all of you that are listening. Why I think incentive programs are important just in general is that they're an attempt to align the individual's interest with the common collective. And there's a bunch of general examples of that, but I think the most prominent ones that you can find today are going to be something like equity-based compensation and also productive welfare, which is generally used for welfare stamps, and that you have to be a part of the workforce in order to receive that benefit. Those generally translate into blockchain, and blockchain is a new space where we're not going to reinvent the wheel, but we're going to explore today how we can design new incentive programs for these new digital assets. I'll allow everyone here to introduce themselves, starting with Mel, and then we'll go just to the right.
Hi everyone, my name's Mel. I go by mel.eth in the metaverse. I'm the founder of oxcart.vote. I also work for stablelab.xyz. And we design all kinds of incentive programs and facilitate governance at DAOs. We do data analytics, run nodes, and also are getting into agentic infrastructure.
Nice to meet you, everyone. My name is Liberman. I'm the co-founder of Delphi Digital and managing partner of Delphi Ventures, where I spend most of my time investing across DeFi, infra, gaming, and AI. And then on the Delphi Digital is a research firm where we do a lot of research and consulting. And then we also have Delphi Labs where we do incubation and acceleration.
Hi all, I'm Paul Lay. I run the protocol strategy team at Gauntlet. Gauntlet is a DeFi cryptoeconomic modeling company founded in 2018, based out of New York. We primarily do two lines of business. Number one, quantitative consulting. So we help protocols like Compound, Uniswap, Near develop and execute quantitative growth strategies. And the second thing we do is we run vault strategies. So customers can deposit funds into Gauntlet managed vaults where we optimize risk-adjusted yield. So yeah, looking forward to chatting today.
Yeah, and I'm Robert. I'm a small part of what makes Blockworks excellent, and I work on the token transparency framework as well as incentive design here. So we'll start off with our first question. For a DEX incentive program, what clear steps must a protocol take to build an incentive program? For instance, define objectives, choose program types, decide on attributes. We'll start off with like the top of funnel ideas really vaguely, and then we'll get into more specific design here. So please, I'll direct that to you, Paul, first, and then whoever wants to jump in after that, go ahead.
Sure, yeah, at Gauntlet, we work with a variety of protocols, including Uniswap, on DEX incentives and growing those pools. I think there are a couple elements that contribute to a successful program. I think first it's around defining what your goals and KPIs are. Is it to maximize liquidity, volume, fees, etc.? Is it to optimize for price execution or to facilitate liquidity around more tail events? Is it to grow certain pools independently, or is it to facilitate a cross-protocol or cross-chain migration? I think first it's around defining what the goals are. From then it's obviously constructing specific plans for what that incentive budget is. So how much do you allocate, and which pools do you allocate those incentive rewards to? And then the third is ongoing monitoring and performance. Predictive models are only as good as the data that informs them. So once a program starts, it's important to monitor, hey, how is user behavior changing? Where is liquidity coming from? Is that liquidity sticky? Are these pools growing in the way we expect them to? And then calibrating those incentive distributions over time. So yeah, I think there's a couple of elements that contribute to it, and yeah, interested to hearing more from others.
Yeah, no, that was a great summary. Not to kind of repeat any of that. I think ultimately you end up, optimizing for fees, and then the question is how do you get to that state? Is it something where you need to generate enough liquidity for this thing to actually work and get to a point where you're getting to a profitability, or is it something that's already viable and you're kind of more so throwing fuel on the fire? I think everything you mentioned made a lot of sense, and more recently we've started seeing, or it's been probably about a year, but the advent of points, and I think points are just basically another derivative of a token, but it allows you to be much more kind of precise and measured with where you're directing incentives, because it's very forgiving. Whereas if you're distributing a token, it's pretty one directional and you can't really do much. Points really allow you to be more precise. And so I think that's been a pretty promising development. And some of the stuff you also have to think about when you're thinking about the longevity of these incentives is kind of the amount of tokens you're giving out and how they flow into the ecosystem. So I think points are useful in that sense too, because it's something you need to think about. Ultimately, if you're over rewarding and you create a downward spiral, you're really diminishing the long-term value of kind of the incentives you can offer.
Yeah, so Jan and Paul just mentioned two very important points, but I think the key words here that I want to pull out are treasury and life cycle and funding. And I'm going to throw this question to you, Mel, specifically on how a protocol should finance the reward pool dependent on its life cycle. And I think both of you touched on this briefly, and that was like the objective of the first question of like, we need to think about whether or not how we define our objectives, how we define our process, and what the end outcome we want. But if we don't have the proper funding to create this initiative and have it generate an equilibrium at the end, then the incentive program really isn't worth it. And so we'll start there with funding.
Yeah, I think, we covered some good ground. And for me, what it really comes down to is the metrics we're trying to achieve. And I think guardrails and governance really go to that. I think my position in the ecosystem would probably, of course, incentivize me to say that. But once you start distributing rewards, you get really good signal as to what the behaviors were prior and then after. And so incentive becomes, in a sense, reward. And with a governance token, the incentive we put out the door today becomes a new governance structure tomorrow if token-based voting is the way. And so with that, what kind of guardrails do we have around epic reviews and such? One important thing that comes to mind too is for something that delegates can do extremely well is read extractable value, perhaps better than a machine can, in the sense that whatever we put out as reward is typically trying to do more with less. However, we often have people trying to do the same. And sometimes we can get basically those incentives going out the door in ways that are less accretively valuable to the outcomes of the protocol, over time. And so we can iterate on that as long as there's accountability both in the program and in the delegate pool.
Totally, and this is like why designing an incentive program around your protocol-specific technicals is super important. And a great example of this is something like Uniswap or Arbitrum. Those are two different types of incentive programs. One is a DEX focused on AMMs, and then the other is an ecosystem. And when you think about an ecosystem and how they are supposed to be designed versus an incentive program like a DEX, you have to take in a couple of different variables. Like, for instance, whether or not your application layer is going to be competing or whether or not you have pools competing. And I wanted to throw this over to you, Paul, because I know that Gauntlet has been doing an incentive program on Uniswap that has been rather successful. And I want to get to the bottom of like why that is. We've spoken about funding, we've spoken about objectives, we've spoken about targeting KPIs like volume and liquidity. Let's get into concrete examples, and would love to hear more on that.
Yeah, I think, whoa, that was loud. I think there are kind of two elements to think about. I think the first is what is the quality and robustness of your economic models? How do you actually think about LP behavior, trader behavior? How do you identify certain pools where that ROI is going to be the highest? If you do spend a certain amount of incentives on that pool, will actually reach a threshold to be competitive and thus acquire a lot of trading flow. So I think the robustness of the economic models is something that we invest a lot of our resources and time into improving. And I think the second is interesting thing about Uniswap is that it's not just a DEX incentive program. When it comes to Unichain and growing the Unichain ecosystem, that is a ecosystem incentive-like program, right? So how do you actually build an ecosystem? And there is a structured path generally towards doing so. You don't want to necessarily, incentivize certain protocols without understanding the downstream effects on others. In general, it's important to bootstrap DEX liquidity, trading liquidity, for a variety of reasons. And then you can kind of move into lending protocols where liquidity on chain is sufficient enough to support higher supply caps and greater capital efficiency for lending protocols. So yeah, I think not just the, case-specific modeling itself, but also how do you sequence the incentive distribution to make sense for an ecosystem-wide level.
I would just double tap on that. We're delegates at Unichain, large ones, and I was on the Uniswap Treasury Working Group, and so I was using Unichain before the liquidity program, and now I do after. And as a test case, I think like stablecoin trades were incurring like 0.5 point of slippage, and now you just get what you get at. I'd say it's evenly matched. You get exactly it's par. And so that, I think, a couple $1 million worth of spend, every single user at every single trading volume, as I've experienced it, is having a much better experience. And the optimization around that was, I think really well targeted, so using, again, a thin amount of capital to achieve a super large, and I would say critical objective. It was critical to the success of Uniswap as a whole that Unichain be bootstrapped effectively. And so, just good job. But all in. The one thing I wanted to kick out there is maybe like Oracle extractable value seems to be on the table now, where these types of things where that was a form of extractable value by those who were providing liquidity, or without the incentive program. We kind of do leave things like that on the table to arbitragers and whatnot, but they are being pulled out. Like at Compound now. Having service providers for Oracle extractable value is a cool development, and might actually double the amount of revenue coming into the DAO. So these types of programs are huge.
Yeah, they're getting really big, specifically on Uniswap, and we've commented so far on designing for Uniswap, and so let's just stick in this area and kind of double click. Jan, you mentioned earlier in our conversation that we're targeting specifically fees and incentivizing those. And I'm really interested on this dichotomy of targeting fees versus volume. And why would you even do that? What's the reason of targeting fees when all I want is volume?
So I think all roads lead to fees in terms of what you're trying to incentivize. So, in the end, volume isn't necessarily the best outcome. It's basically saying, volume can be wash trading. So if I'm targeting fees, maybe I want to provide incentives to the market maker side, not the market taker side, right? And so in the end, it's not that I'm rewarding volume, but I'm optimizing for a specific type of volume that's going to increase liquidity, and that should lead to more fees. So it's all kind of, I think your decision isn't for fees specifically, but it's like what will fees respond to the most? What will create the best user experience? And so, and then in the end, the calculus is kind of, like you said, doing less to get more. And so you need to get to the point where, the spend is actually accretive, where, I would kind of think of token incentives. If you had to do like an equity proxy to stock-based comp, right? It's basically a dilutive element that's meant to incentivize the best behavior from people that are core to the company, and so it is a cost. And so you ultimately want to make sure that you're getting more than you're spending. Otherwise, and it doesn't necessarily have to be initially, right? Because you kind of want to get to a bootstrap point, and then after that you can be more precise. But I think this is even going back to the kind of the points element is, if you do these fixed rewards, I think it becomes a lot more difficult to be accurate, because you have to work with less information and make these predictions that are just ultimately really hard to do. And you'll likely be wrong. It's just a matter of to what degree. So it's kind of this fine tuning of the incentives constantly, and seeing, really getting the most bang for your buck is ultimately what's most important, since you have a finite amount of them.
Yeah. Jan mentioned an important point about wash trading. It's something you see that happens a lot on lending protocols as well as DEX protocols, especially through incentive design. And that's super critical. And the reason that's super critical to get right is because you don't want to induce too much wash trading. And the result of that would be an ineffective incentive program as well as an ineffective equilibrium for your DEX or lending protocol. And so let's talk about that equilibrium a little bit. The supply and demand side dynamics between lending or DEX AMMs and how you balance the two. Do you totally incentive the supply side? Do you send more incentives to the demand side? Does this matter based off of the point in the protocol's life cycle? I'm going to give that one generally to the group, and whoever wants to handle it first, please go ahead.
Yeah, I think so. Not all trading activities created equal. There's some behaviors you want to incentivize, there's some behaviors you want to disincentivize. I think when you're analyzing the efficacy of an incentives program, for example, it's important to understand, hey, like how much of this does seem like trading from LPs that are just trying to reap all the rewards across the range of liquidity that's being incentivized. That's not necessarily the type of behavior, the type of sticky, sustainable behavior you want your protocol to promote. And I think the interplay between supply across DEXs and lending protocols is very important. There are going to be scenarios where for stakers, for LPs, it becomes a lot more attractive to, for example, borrow on lending protocols versus providing liquidity on a DEX. And if much of the supply is concentrated on a lending protocol versus the DEX, this can create outsized risk for the lending protocol in that there's not enough on-chain liquidity to facilitate liquidations in case there's price volatility of the collateral assets. So I think understanding the amount of relative supply across DEXs and lending protocols is one thing to consider. And I think within lending protocols, the amount of assets supplied for lending versus the amount of assets supplied as collateral for borrowing, all that is pretty related. I think incentives in general are powerful for solving the chicken and the egg problem, where whatever side of the trade is more difficult to bootstrap, let's incentivize that to get the flywheel going. For some asset pairs, it may be supply, right? So you need to incentivize supply side liquidity in order to have enough liquidity for borrowers to tap in at relatively stable rates. For other scenarios, maybe the supply is already there, perhaps because it's a multi-asset pool. Now it's about how do you facilitate the right type of borrowing activity. So I think incentives are most powerful when it's targeted towards whatever side of the trade is more difficult to bootstrap, whether that's supply side, borrow side, or market makers for perps.
Yeah, I think when you're designing these, you assume the goal of the token is basically to organize a bunch of self-interested parties in a positive sum way, right? And so you have to assume that everyone is going to max extract, spreadsheet warriors to the max and try and figure out how to make money here. And so that like it's a tricky thing to battle with, and over time people get more and more savvy with how they extract. So you do need to kind of keep that balance in mind. And it's funny with incentives. So certain concepts or mechanisms need incentives to get past the bootstrapping phase where the protocol can actually become viable. In other scenarios, you have to have incentives because your competition has incentives. So it's more just like out of necessity than out of, or in response to competition than out of individual siloed necessity to the protocol itself. And then in terms of like what stage and how much it matters, I think it really depends on the protocol. So for lending, for example, I think it probably matters a bit less. I think with lending, it ends up being more of a trust situation, right? Where I'm not really trying to maximize my yield because the differences are so minimal. We're talking probably 1 or 2% over the course of a year. I'm just trying to minimize the probability of a full loss type scenario. And so that's why, Aave doesn't really have that many while others do, but Aave has this kind of long-term trust and, stuff continues to break, but this is the most battle tested. And when you're thinking about borrow lend, that's something that I think you kind of optimize for as the depositor or the borrower. But like you mentioned, with those, you just need to get to a point where there's enough liquidity such that the market can respond to changes in the interest rate curve, and okay, there's a lot of borrowing demand, and so there's going to be a lot of deposit yield that's available because there's so much utilization, and then vice versa. If there isn't, there's going to be more borrowing activity that happens. So I think for lending, you kind of need to get it off the ground, and then ideally you let the interest rate component dominate the flows. And then on DEXs, yeah, it kind of, you break it down whether it's a spot DEX or a perp DEX, because I think you're kind of solving for very different things there. And so, yeah, we've seen that, but I think that's like a longer rabbit hole to go down for thinking about those two.
Go ahead.
I would just note too that oftentimes the reward we're pushing out on DEXs is the governance token itself. And there's a lot of research going into, basically, if we know that most of the actors are going to open sell whatever they get, not as a governance token, we can take steps to try and create reward structures that maybe respect, the types of rewards that the actors would like to receive. Because the thinking is we could use a treasury manager to allocate into different assets much more efficiently than just basically trusting that open market selling over the course of the rest of forever is going to somehow happen well.
Yeah, I mean, we've all made some really great points here. Paul, you touched on the balance. Jan, you touched on isolation, and then the actual management from Mel. And I think this all integrates together into the question that I was asking, which was the balance between supply and demand. And so what we kind of spoke about here, and then we're going to move into another question, is the balance really depends on the protocol, the point in the protocol's life cycle. The earlier it is in the life cycle, perhaps maybe you want to incentivize the supply and demand side. And the reason that is because you need to bootstrap both the interest and also the capital. And that was something that you were commenting on as well, Paul. And then Jan was also mentioning the fact that these protocols need to make decisions not in isolation. They exist within the ecosystem, and also they exist within the wider context of blockchain, capital, and distribution as a whole. And so what that creates is a really challenging problem that we all need to overcome, which is how do we even start designing them? And I think the most important thing that we've said in this previous conversation is like it needs to be a combination of all these different vectors, both your management, your understanding of the market structure at large, and then also the really small intricate details at the protocol level. And so let's stay on the small details of the protocol level just to provide a little bit more value, specifically in terms of DEXs, because I think that's really interesting. And then we'll go into like the wider, more ecosystem approach. And so this question is going to be very specific based off of how we're thinking about bootstrapping incentive programs for pools that are currently dead. So you look at Uniswap's new program, you look at a handful of other AMMs. What they're going to do is when they bootstrap these pools, they're going to choose a certain amount of incentives that goes to either side of the pool, or they're going to choose a certain percentage of the incentive allocation that goes to the actual LPs that are creating fees. And there's a handful of different strategies to do this. A couple of them are called 98-1-1, where 98 goes to the people contributing fees, 1% goes to either side of the pool. Another one is called 40-30-30, where 40% goes to the people contributing fees, and then 30 goes to either side of the pool. And so I'm going to turn the question back on our panel here, which is when you think about DEX design, what are some of the really specific implementations that you're going for these pools? And maybe I'll give that one to you, Paul.
Yeah, I'll start it off. So first, let's talk about the general flywheel for why it's important to kind of bootstrap liquidity, and then we can talk about like 98-1-1 and the other structures you mentioned. So in general, as we know, this whole cold start problem with liquidity, in order to have trading volume, you need LPs. In order to have LPs, you need trading volume to generate yield for the LPs, right? So generally, how we think about the incentive flywheel is not, spending forever. It's about spending to bootstrap pools, and it's about spending for strategic initiatives, whether it's TVL migration or whether it's to be really competitive against the upcoming protocols. So for incentives, like if you want to bootstrap liquidity, you incentivize the LP side or the trading side. You get the initial LP providers. That provides liquidity for trades at low slippage. Traders come in, those boost up yields. Boosted yields create more demand for LPs. More LPs create more liquidity for better slippage, and that becomes a flywheel that you make sure it's sustainable over time. I think for one of our relatively recent programs, when we were incentivizing Uniswap on Arbitrum, we're trying to decide, hey, which pools on Arbitrum do we incentivize, how much to incentivize, and how does that change over time? I think we did the 98-1-1, where 98% of the incentives were targeted towards LPs that were providing liquidity that was actually being used for trades. So essentially, this type of structure concentrated incentives around price execution for better price execution for traders that want to, write larger checks. So we really wanted to optimize liquidity around the execution price point. And when it comes to identifying, hey, how much incentives do you need? It's around, hey, like what are the competing pools out there? What are the trading costs for a X amount trade for the competing pool? Now, how much liquidity do we need in order to be competitive with that trading cost if you're assuming rational traders? And then we have models that predict, okay, for $1 of incentive spend, we expect to capture X dollars of liquidity. And with that liquidity added to the pool, now this pool will be competitive against the alternatives. So that's generally how we think about it.
Yeah, no, I think you absolutely nailed it. I kind of agree with everything you're saying, but just to kind of double down on the 98-1-1 point, I think that's really the path that makes the most sense, and it's the one that scales. And so the idea is you're incentivizing the capital that's actually being traded against, and that's a kind of a development after Uniswap v3, where you can have concentrated liquidity, because otherwise you're kind of just rewarding long tail liquidity that's not really being used, much farther away from the price. And it also, the most important part is that the incentives scale to a much better degree. If you think about the amount of assets that are in these pools and then the amount of rewards that are going to them, if all of it is going across the entire LP base, it doesn't move the needle if it's not, unless it's really dilutive to the protocol where you have to issue so much. And then you kind of get in this downward spiral where people are selling, price goes down, and then you have each token can impact the protocol less and less. And so actually just rewarding that portion is very important for that. And it also incentivizes the right activity. Everything is priced at the margin, and so that's where liquidity matters the most. And that's kind of just a more precise way to go about that distribution. But yeah, no, I agree with everything you said.
Yeah, so what's interesting here is that both you commented on pools that I think are going to be using something like a USDT, USDT0, USDC, and these are really well-adopted stablecoins and tokens in general. But when you go and look at something like Pump.Fun, it's going to use a Uniswap v2 model, which has a wider breadth of liquidity. And the reason that's happening is because there's not enough of concentrated LPs, and also price discovery is currently happening at this point. And so maybe something like for tokens that are not as well developed and adopted by the industry as a whole, you want to use something like a 40-30-30. And that's because you want to incentivize both the liquidity side on either side of the pool pair, instead of just the fees being generated by the LP itself. Do you guys feel like that's correct?
Yeah, broadly that sounds right.
Yeah, sounds good. Okay, well, so I think what we've done so far is we've talked about, from a high level, how we design, how we operate, how we maintain, and then we talked about really detailedly the types of integrations for a DEX. Now we're going to take a step back in these last 10 minutes and talk about an ecosystem approach. And we've made a couple different references to the fact that these protocols don't function in isolation, and these incentive programs also inherently competitive. And so what I'm wondering is, how should we go about building an ecosystem level incentive program? And sourcing the information that we need when all this information goes into forums on other different ecosystems? And more specifically, how do we build a program that is the most competitive today? And this is perhaps the billion-dollar question. So we'll work together to come to an answer in these final 10 minutes. Would you like to take that first, Mel?
Yeah, I'll kick it off. I think the approach comes down to building the team that can do the types of things that you're going to need to do in an ongoing basis. And I think the model we have of delegated authority is a really good one. I think there can be challenges there around, again, the extractable value problem at the highest levels. But I think if you can get that right, and what I'll speak to there is like delegate accelerators, things like that, where part of the core curriculum is token engineering is just essential these days. It's having governance participation, but not understanding core incentive dynamics is real risk. And so I think protocols are starting to understand that there's an epistemic function to these fee designs that's really coming into the design elements. And so I'll just kind of park that there and then kick it over.
Yeah, I think when it comes to building the ecosystem and building the team, there's obviously the growth managers, there's like the quantitative data scientists, there's the community manager, because there's going to be a lot of requests to get incentives and whatnot. And I think you're really trying to balance a lot of competing factors or factors that could be competing. On the one hand, you do want to make it very quantitatively driven. X dollars leads to Y result, and you really want to maximize the ROI. But there are also probably intangible elements around, hey, maybe incubating some new teams that you're bullish on or whatnot. So I think, maybe one of the underappreciated aspects is kind of balancing the quantitative ROI with the qualitative relationship building, community building that is important for an ecosystem.
Yeah, I think, when DeFi kind of started, prior to that everything was incredibly centralized, one decision maker, opaque. And so all the issues there were very obvious. And then with DeFi, everyone swung the complete opposite direction where completely decentralized, the ultimate decision making happens via tokens, and naturally there are going to be exploits, government attacks. You can borrow a bunch of a coin and then put through a poor incentive proposal and kind of max extract. And so we've kind of strayed back towards the middle where if you allow that far decentralized one, then there's going to be kind of max pillaging to some degree. I think the one in the middle is important because part of what makes you interested in a certain ecosystem is the team behind it, right? And so there's a certain amount of trust that you put into their decision-making ability, and not to say that they're always going to make the right decision or take in all information, but I think it's important to have some degree of control, but also at the same time engage the community, have these useful forum discussions where everyone's kind of providing different views and optimizing. And so it ends up kind of boiling down to finding that sweet spot between how do we actually get our community involved and leverage them, but still make sure that, in the end, the team has some decision-making override power to ensure that, you don't have any kind of nefarious or extractive actors.
Yeah, totally. Sorry, I meant Mel. The three answers that we've gotten so far are incredibly on the dot. I think largely what we're looking at today is ecosystem incentive programs have been functioning in a sort of parallel way where the applications within the own ecosystem is competing. And it's almost like a parallel compute, a CPU, all functioning with their own registers. And what we need to be seeing happening today is something like a symphony where you have the bass and the drums that are setting the tone and the timing, and then you have the rest of the quartet that's doing all the other things that make great music. And so when I think about an ecosystem incentive program, I often think of lending as the backbone of the ecosystem as a whole. And what I'm wondering for all of you is, when you look at an ecosystem, what's the backbone keystone DeFi primitive that is the first protocol that you would incentivize, and that would then distribute liquidity to the rest of the applications in the ecosystem?
I think that's a really good question. I hate saying that it depends, but it really does depend. It depends on the use case of the asset you're trying to incentivize. I think throughout this conversation, we talked a lot about growing, protocols within an ecosystem. At the end of the day, it's around growing use cases, and those use cases are dependent on the asset and the users that are interacting with it. So for example, there's some assets that may be seen as a store of value, like Bitcoin or et cetera. And one of the use cases is to, purchase Bitcoin, but also use it as a source of capital for liquidity, borrowing against it, so that you don't have to sell your Bitcoin in order to leverage some of the liquidity. And from that aspect, lending is very important. And to get enough liquidity for lending, in order for the risk to make sense, you need DEX liquidity, right? Because the DEX liquidity is facilitating the liquidation. So for those types of use cases, you may think about, okay, is there enough DEX liquidity? If not, all right, let's maybe incentivize DEXs first in order to have this asset as a collateral asset. For other assets, it could look very different. So Gauntlet is working a lot in and around RWAs, real world assets, tokenized assets, such as private credit. So we're working with Apollo on S-Acred, running levered RWA strategies for them. For private credit assets, the use case is around generally leveraged yield. So if you are a LP and you are owning this, S-Acred asset, private credit yielding around 7-8%, if you want to borrow USDC, that's cost 3-4%. You borrow the USDC, use the USDC to mint more S-Acred, and now you have a looped trade where you're getting leveraged yield, and that trade is profitable as long as the spread is positive and the yield for private credit is greater than the cost of borrowing USDC. For these types of use cases, now we have to get a lot more granular into what is the right place to incentivize. Are DEXs the right place to incentivize? Probably not, because S-Acred is a permissioned product. You need to be KYC to interact with it, and public pools don't really work as much. What about private permission pools? Maybe, but for an asset like this, it's probably better to have market makers, right? So that type of structure may be different from just incentivizing a permissionless pool. So yeah, to kind of answer your question, which I guess I was very roundabout, it really depends on the use case and what are the blockers.
Yeah, I think if you're starting from scratch, it has to be DEX first, because the lending market can't function without underlying liquidity for the liquidations. And I think that's probably the simplest way. And then once you get to that point where the two can coexist, then you become more kind of surgical. But I just think you can't have a lending market without a decent amount of liquidity for collateral, for liquidations to actually take place on an ecosystem.
Yeah, I think it. I might come back to lend borrow, because again, I think the more maybe the more liquid Bitcoin we have stuffed in places like Aave, again, that borrowability, things like that. It's a really tough question. I think it kind of also makes me go to a place too of the stack, right? So the more liquidity we have in Bitcoin at large, the more supportability we kind of have in all other blockchain spaces. But I do think that it really comes down to trust as a key metric. This is kind of a meta governance principle, but not only that we're taking care of what we're taking care of at our protocol, but that all other protocols, or at least the ones we engage with as infrastructure, are going to do that thing as well. And that really often does come down to the governance surface of that thing. Bitcoin has a very, I'd say, small governance surface, so there's a lot of trustability that it's going to persist. I think protocols are honing in on the one or two things that should be able to be adjusted to do whatever it is that thing does, so that people can build confidence that they can grow to $1 billion plus TVL, and that governance or some other mechanism isn't going to create a non-accretive value flow long term. And then again, what is the accretive value flow where we can flip a switch and fine tune and kind of get to that place? So I think it's all moving in the right direction, but slowly.
Yeah, I mean, I agree with all of you. I think that's a nice point on. And also, you're right. You definitely have to bootstrap decks before you get to lending. And also on the operations side, the everything needs to be set in place before you decide on expansion and dealing with the underlying structure of the incentive program, as well as it depends on whether it's Bitcoin or Ethereum or anything else. So it does depend. You're right, Paul. And I'm just going to close it off here and say that in our last minute, I think we provided some value. Hopefully the audience enjoyed it. And wanted to say thank you to our panelists, Paul, Jan, and Mel. So I very much appreciate it. And I hope to do this again.
Likewise.
Thanks for having us.